Hello and welcome to the S&P Global presentation on integrating ESG to de-risk portfolios and identify opportunities. My name's Michael Salvatico and I'm the head of ESG in Asia Pacific. It's a pleasure to be here with you and today we're going to cover a number of areas across ESG, and the focus will be on the de-risking portfolios, which is clearly an area of ESG in terms of where our investors have been focused over more than a decade, but also how to identify the opportunities in your portfolios and investments, and those themes are coming out from the analysis that we're doing around climate opportunities, especially. This topic of ESG really is relevant to all parts of the business community. I mean, investment managers and asset owners, as much as it's relevant to banks and to corporates, especially on the climate change side, as we'll see, regulations really driving the integration of climate assessments, benchmarking and reporting. Why ESG? Well, hopefully, the fact that you're joining this means that you've had some exposure to ESG. In reality, if you have looked at a newspaper or listened to a story on the news lately, you've had some exposure to ESG for sure. But from the industry perspective, ESG is now mainstream in the minds of investors and many corporates, and we're definitely past the tipping point in terms of adoption of the assessment of ESG, especially climate change. So let's have a look at what we're going to cover in this presentation over the next 25 minutes. We'll start by looking at and analysing materials around ESG scores, and so we'll focus quite broadly on ESG scores across the spectrum of environmental, social and governance issues, and then we'll take a deep dive into climate change, and during that session you'll see climate change is so important in the minds of our clients that it really deserves a whole focus on its own. We'll also look at identifying those opportunities. As we say, it's not just about risks, it's also about the options, the investment options that are available, the investment options from an investment perspective, but also from a corporate, where to and which businesses to be capitalising within your organisation. So let's jump into a review of why ESG, because it's also important for you to have a bit of background on what's led to the momentum of ESG in the market today. One way to think about ESG and its presence is the adoption of the responsible investing principles, and that's grown significantly since its origins back in 2006 to where we are today, with greater than 3,000 signatories, and those signatories are all committing to the assessment, promotion, integration, and communication of their efforts around ESG investing. But there was something behind the investors showing their commitment to the UNPRI, of course, and that origins really was around the expectations, the changing expectations on companies to do more than just focus on profits for investors, but to be responsible to a broader group of stakeholders, and to demonstrate that they are good stewards of environmental and social issues, and that expectations definitely coming strongly from communities. It has a voice through social media. And we've seen the regulators have picked up strongly on the demands of companies and their behaviour. So regulation on ESG issues, in fact, has increased exponentially. Looking over the last few years, and definitely saying that if you look at ESG regulations between 2017 and 2018, there was a 100% increase in regulation. So literally 2 times the regulations that investors were or companies and investors are focused on. We've also seen the adoption of ESG guidelines by exchanges, and this is across Asia Pac as well, from Australia to China to Japan, as well as stewardship and engagement groups and guidelines and principles, which have also been country focused, but as much in Japan, where the first stewardship codes were adopted in Asia Pac, but also Australia and across the rest of APAC. There are examples as well. The last thing that I want to add when talking about the momentum of ESG from an industry group perspective is the number of industry groups that have grown on the subject, whether that's the investor group on climate change, the Responsible Investment Association, or any one of the SIFs across Japan or China. One of the larger initiatives that we're seeing today is the Climate Action 100 Plus group, which is very focused on climate change and the large corporates who have large climate footprints. To end the focus on why the adoption of ESG, speaking to you as largely a finance audience, whether you're a corporate that's also interested in how investors are reviewing you as a financial opportunity. Of course, I want to conclude this part of the presentation with a review of how the stock market has performed and how investors have reacted to ESG trends. And on this slide, you can see that if you're looking at from the beginning of the year to the end of March, during the heights of COVID, that actually money was shifting out of non-ESG funds at a rapid rate of over $380 billion coming out of those funds, and yet ESG funds saw inflows of over $45 billion. And so definitely demonstrating that the appetite for more ESG-focused funds was there and higher. We also see performance across indices, such as the Dow Jones 500 ESG index, which has outperformed up until the 3rd of June by over 2.6%, so outperforming its benchmark. So we're seeing actual returns. This is doing good through ESG and doing well through your actual investment returns as well. And the final point there is BlackRock produced a summary of performance of funds, and their assessment of ESG funds showed that during the COVID period, 94% of those ESG focused index funds had outperformed. Similarly, findings with research that we did at S&P, where we identified that 14 out of 17 ESG ETFs had outperformed towards the middle of June this year. So there's plenty of evidence as to why there's been momentum and growing momentum in ESG investing. Let's have a look at what ESG investing is. And we'll do that by focusing on the overview of ESG assessment. So it's an ESG score review. The origins of ESG investing are actually further back than you might appreciate, and here's the view of the ESG Scores team that's now part of S&P and was part of Robeco Sam up until the beginning of this year. Here's the view that they began their assessment of what they sought to achieve by reviewing ESG criteria in a company, and their expectation was that the research that they were analysing was going to have an impact on a company's growth, capital efficiency, and risk exposure. Now, the origins of that thinking come back to the acknowledgement that in today's world, a large part of a company's valuation is driven by intangibles. Now, if you see here on this chart reviewing companies in the S&P 500 and assessing their market value, you'll see that from 1975, where 17% of the market value of a company was identified as being related to intangibles, to where we are today, or in the last assessment on this slide, which is 2015, where actually 84% of the company's valuation was driven by intangibles. And the ESG focus is to identify these intangibles, or part of the ESG focus is to identify these intangibles. In fact, there was a time where ESG was reviewed or thought of as an intangible assessment. ESG's demonstrated that beyond an intangible review, it's actually identifying real events and having real impacts on a company. Let's have a look at what the different types of intangible assessments can relate to. And we're going to do that through the focus of materiality. So from here on, when we're looking at the ESG scores, we'll introduce the concept of a materiality focus, which is important because it is the material aspects of an ESG assessment that have been more closely linked to company long-term performance. So some of the questions here are around understanding those intangibles are listing out the different aspects of company capital. So if you see here, some of the concepts you'll probably be more familiar with around intellectual capital, similarly brand capital, are intangibles that more fundamental analysts, or let's say traditional analysts, as opposed to ESG analysts, if you're making that distinction, traditional analysts would recognize and value companies on. And for some of the other areas are greater ESG focus, like customer capital, manufactured capital, human capital, being a big component of the social issues around ESG assessments, social and financial capital. And you'll have seen in your own analysis or through the events, ESG events over time, that there is a link between growth, profitability, capital efficiency, and risk within these areas. So let's take a deeper dive into how to review a company through the ESG lens. When we're assessing a company, the starting point is to look at the criteria that affect the operations, products, and services of that entity. What we recognise is that there are many criteria to bring together to assess a company, or all the different kinds of companies. And in fact, if we look at the different criteria, and there are some samples here. For instance, under social, then include human rights and labour practices, or governance, code of conduct and compliance. What we find is that in fact there are over 100 criteria that we can recognise when looking at all different kinds of companies. The challenges then are that some of these criteria are are critical to a company in terms of the potential impact or the magnitude of an event, whereas others might not have the same consequences. And it's logical that when you're looking at these companies and determining which criteria apply more than other criteria, that you see different industries can be grouped together. Different criteria can be grouped together under different industries to identify more clearly those criteria which have a greater likelihood of impact. And we do so through the lens of an assessment that looks at likelihood of impact and magnitude of impact. So here's a good example to bring that to life, looking at the pharmaceutical industry. And you'll see on the chart that right up in the top right-hand corner, which is the greatest in terms of likelihood of impact and magnitude of impact, that you have product quality and recall management, which has been identified through the assessment of all the criteria, right down to environmental management and product stewardship. Now, this is some of the examples, because this isn't all the criteria we look at for the pharmaceutical industry. We look at roughly 23 of the 100 criteria for the pharmaceutical industry. In fact, on average, we look at 23 criteria for any particular industry, and we break the world into 61 different industries and group companies together. Once we've identified the criteria, we then take a deeper dive at on the focus on materiality, and that focus on materiality is determined based on the different criteria. Let's move to the next slide, and we'll have a look. The doubling down on the focus on materiality is, as I like to think about it, is to say, well, that we've identified the 23 criteria through an impact and magnitude assessment. Even then, when we're looking at the different industries, it becomes clear that the combination of E, S, and G factors have combined to have a different overall impact on the ESG score. And this slide provides a good example of that, looking at three very different industries, from metals and mining, restaurants, and pharmaceuticals. And what you'll notice on the slide is that there's a very different ratio of total weighting towards the ESG score from E, S, and G factors for mining, which are identified by the different colours, and you'll see it's roughly a third of the overall ESG score will come from a weighted E factor and G and S. Whereas if you compare that to a pharmaceuticals industry, the overall weighting of the criteria from governance is roughly half the impact on the ESG score, and the large part of the remaining impact comes from social issues. And so thinking through to the industries and their impact on social issues and environmental issues, looking at this kind of analysis provides you with a view of how those companies' ESG assessments are determined. Having a look at the research that goes into the analysis, one of the ways that we're bringing information to our assessments, which is identifying risks that are forward-looking, is that we're asking questions of the companies that capture those issues that potentially underreported, issues that the company might not yet have even considered reporting reporting in their sustainability disclosures, but that as an investor-focused ESG scores review, we're concerned about, and so we're coming to the company through our corporate sustainability assessment, and in that assessment, we're asking questions around issues that are capturing those trends. Examples of those trends that were captured early in our review of the CSA was around human capital or human rights, where we were asking questions of companies on those issues back in 2002. And when you think about the general emphasis on those issues, Human Capital Management Coalition was established in 2017, and likewise with the human rights issues around ESG criterion for money managers, it was really around 2018. Similarly, we were early in identifying and asking questions around climate strategy or tax transparency, and more recently around policy influence. All of these questions that we ask clients are captured in our survey, and to understand how that survey is brought together in the overall results of an ESG score, let's have a look at the final product that comes together to assess companies on that ESG lens. Now, here's an example of the overview of the ESG scores. Starting on the far right-hand side, you'll see that 1,000 data points. So the 1,000 data points are data points that we're asking the company through our CSA survey, ideally, to those companies that are participating in the survey. We're able to collect that information, verify that information with the entity, and then bring those data points together under 100 questions, which we're analysing, 100 questions on average. The questions then go into the criteria score, which we saw some examples of in the previous slides. Those criteria scores are weighted up to the ESG score, S&G score, and then weighted to the ESG score. Currently, we have 7,300 companies that we're assessing on ESG scores, and we're providing a 5-year history of those ESG scores through our market intelligence data delivery services, delivered via Express Feed at this point in time, but soon to be on Market Intelligence desktop. So let's take a greater focus on climate change, and spend a bit of time looking at climate change on its own. To understand better the reasons why climate change has become a research focus on its own, you need look no further than the TCFD reporting. So the TCFD Task Force on Climate-Related Financial Disclosures, which brings together a framework that's been quickly adopted by investors and companies in terms of measuring their governance and strategy and risk management and metrics around climate risk. There are around 1,000 supporters of TCFD globally, and around 500 of them sit in Asia-Pac. So it's a strong representation of their support for TCFD in the Asia-Pacific region. Other initiatives that we'll look at are Sustainable Development Goals and EU Taxonomy, and we're really able to identify an opportunity focus through those lenses. Let's analyse the costs and the preparedness perspectives of companies through the lens of climate change, and here's a couple of metrics that I've pulled out for you to bring home the size of the climate change issue for our economies. And so if you have a look here from left to right, you'll see that there is a $5 trillion natural capital cost that's identified and that's just looking at the largest 1,200 companies globally, which demonstrates a 1.5 times the costs to net income. So a very significant impact on companies. Also important from an energy perspective is how we're creating that energy, and 57% of global energy still comes from fossil fuels. That is decreasing, which is part of the emphasis on stranded assets, and we're seeing an uptake in renewable energy, so growth in renewable energy of 4%, and renewable energy making up 20% share of the energy grid. In terms of how corporates are performing, we've seen carbon targets from 25% of the 1,200 global companies, and carbon reductions, 25% from the largest 1,200 companies, and 58% of companies with carbon targets. That's increased by 16% over the last 5 years. As well as companies with water targets. So water targets are something that are underrepresented in our thinking, that here we say that 25% of companies have water targets, meaning that 75% don't. The big area of focus from a TCFD transition risk scenario analysis perspective is the future carbon risk, and 23% of the top 1,200 global companies' earnings are at risk using the analysis we have from a high carbon scenario in 2050. And we'll look a little bit deeper at that as we go on in the presentation. As we think about TCFD, I certainly introduced it and talked about it at the beginning, but the way we work with clients is through analysing their TCFD assessments, the quantitative assessments, in particular from their TCFD exposures, and that involves starting with the baseline and understanding carbon footprinting, the exposures including Scope 3, looking specifically at areas around stranded assets. So we do reviews of coal and renewable energy shares. And then the scenario analysis, focusing on transition risk, especially around the policy risk from a carbon price being applied to rapidly change the focus from our carbon mix today to where we need to be in 9 years' time, which is 50% less carbon emissions in order to be Paris aligned, and a physical risk analysis that covers 7 hazards and looks at the asset level of companies around the world. We also provide reports to investors, as well as banks, as well as corporates on their TCFD positions, and we have examples where banks and investors have published those reports, such as the Bank of France or GPIF in Japan. Over the next few slides, I'll dig a little deeper into each one of the areas of the TCFD journey. And here I've picked out some of the examples from the carbon and environmental footprint analysis. So some of the areas to see here that we've focused on are around the total carbon footprint and carbon intensity, and also assessing the portfolios for energy generation mix, and understanding the financial exposure of these portfolios to fossil fuel activities. So this could be for an investor as much as it could be for a bank, as much as we could be analysing this information for a corporate. On the scenario side, analysing the carbon earnings at risk, here we're identifying the unpriced carbon cost, and you can see the analysis covers an assessment of different scenarios and the pricing trajectories required from a carbon pricing perspective. So we're able to analyse what the pricing point is that companies are exposed to in their current operations and compare that to the difference between what that is and what the carbon price would be required at the point in time that a company is exposed to, and what the trajectory is to achieve an outcome, a low, medium, or high outcome. It's essentially a below 2 degree outcome, a 2 degree outcome, or above 2 degree outcome. And we're able to assess that for a sector and country perspective. On the positive side, we're assessing companies' alignment to the EU Taxonomy. So the EU Taxonomy provides a framework or a list of activities that are classified as green. It's being widely accepted. It was reviewed by a high-level expert team, high-level expert group in the EU, and backed by the government or structured by the government. And so here we're able to analyse portfolios for their alignment with the EU Taxonomy revenue share. You can see in the examples looking at agriculture, electricity, transport and construction, and compare that to portfolios, compare that to benchmarks. One of the focus areas of our research on investments has been around the alignment to the Paris Agreement. So Paris Agreement, one of the first areas of target is 2030, so in 9 years' time, and most of a 50% reduction in emissions required by that point. And so we're able to look at a constituent level or at the company level and assess the company's alignment to a 2 degree world or a 1.5 degree world or more as our clients request. And so you can see here we're measuring the portfolio, its current alignment trajectory compared to what a 2 degree aligned portfolio would require, and that's the dotted line. We're also able to assess the overall portfolio temperature. The physical risk analysis, this is a good example of just how detailed we are assessing physical risk. So if you're reviewing the assets of a particular company, we're able to go right down to the asset level. And here on this chart, you'll see the blue dots are the asset level of a global energy company. And we're showing here the heat wave as a hazard, and what the world would look like in 2050 in a high risk scenario. And you can see that clearly there are assets owned by the company which are in very high risk regions. And so we're able to do this, aggregate the asset level information up to the company level, aggregate the company level up to a portfolio level. And we show that on the next slide. Importantly, we're also able to show the asset level analysis. On the positive side, again, we're analysing the SDGs, so using the 17 goals as the framework for SDGs. We're applying it to companies, so we're analysing their products and services, and certainly their impact and alignment with the SDGs. But the areas that I find interesting are that we're also able to assess the additionality. So reviewing the investment the company's making, and the additional value that investment returns. So an example would be a company that constructs a solar panel farm. That solar panel farm has a far greater additionality if it's in China, which has a high proportion of its energy coming from coal-fired power stations, compared to that same solar farm being in the European countries like Sweden, where there is already a good percentage of the energy coming from renewables. We're also able to look at misalignment to the SDGs through an exposure analysis and review where a company has a negative consequences in its own performance or in its supply chain, coming from SDG or coming from non-SDG activities, whether that's human rights issues or high carbon emissions in its operations or its supply chain. An example of how we bring all this together is the reporting that we do for investors, and here you can see we're highlighting the GPIF report. You can access GPIF report online. It provides a detailed review of the different areas that we've talked about over the last couple of slides, and just how all that information comes together in a way that provides a view on the climate risks of an investor. We can also do the same for a corporate, or we could do the same for the loan book of a bank, which has become an area of interest. We've certainly seen that from Asia Pac investors like Shinhan, who we worked with to assess some of their loan exposures, which they've published in their recent report. To finish, I want to bring it all together for you in terms of just how ESG is foundational across the different businesses that we have at S&P. And so I've been talking a lot about what's in market intelligence, which is the area that I'm involved in. Market intelligence has the data and tools to help assess ESG risks as well as fundamental risks, and this provides our clients with the ability to integrate the ESG research with fundamental analysis. As we've seen, the analysis covers ESG and climate risks. One of the key areas of our climate and physical risk analysis is the deep coverage we have of over 15,000 companies, and we're able to look at private companies as well, which adds another 5,000 companies to our review. We're assessing companies not just on their own exposures, but also looking through the supply chain as well. And we're able to do that even more so through some of the data sets that market intelligence has, like Panjiva. The ESG research is also foundational in the ratings, with ESG evaluations and green evaluations, and with the indices, which we've been running ESG indices for 20 years in the DJSI as an example. And we also have a deep dive assessment of energy and commodities through Platts. I'd like to thank you all for your attention during this time, and look forward to answering your questions. Thank you very much. Thank you for those who've come through and asked questions. I've got a couple here on the same topic, and that really is around, is there a globally accepted ESG standard given the subjectivity of the valuation of the criteria? I think what's important to... What's important to consider is the methodology of the ESG assessments. I mean, in terms of this, the theme of the presentation, in identifying risks and opportunities, it's really about understanding what it is the ESG scores that you're looking at are aimed to achieve. And so, if there are... The different providers have a different view on what the key themes are, and even behind that, if you're looking at the reasons that certain criteria are chosen, the methodologies are what's, or even before the methodologies, I should say, the goals of what the ESG scores are trying to achieve are different. That's why we're working with the companies, we're very closely engaged to the companies, and our view on the ESG scores is to assess them through the lens of an investor. We've been doing that for 20 years. We feel that what we have is a good way of providing a standard for the company's assessments. So yeah, there's some thoughts about a ESG standard. Certainly in Europe, there are some reviews of whether there should be a standard. But at this point in time, I think it's important for the investors individually to work closely with the ESG provider. As I say, as a data provider, our goal is to inform the market, to enable the market to make better sustainability decisions. I've got time for a few more questions, so I'm going to take these through. In terms of understanding the ESG investments offered by providers around tobacco, uranium, coal mining, and forest logging. As an investor, you could imagine there'd be some skepticism with the issuer, if only trying to show a better social imprint. That's another way of asking the question around different criteria and methodologies. So for instance, in terms of looking at how the criteria and assessment of a company are made, it's important to consider what your values are as an investor and what you're aiming to achieve as an investor. The way to look at issues like tobacco, alcohol, gaming, controversial weapons, or fossil fuels is as a screen that you apply, a negative screen, determined by your beliefs and values or your client's beliefs and values. That's a separate assessment from the review of ESG scores or of climate risks and exposures. So, many people think about ESG as being one topic, and there being one measure for ESG. In fact, there are many different signals that come from ESG research. So I would suggest, if you're analysing or facing an issue like tobacco, that your tolerance to tobacco production would be zero tolerance, most likely, and that tends to be the screen that's most widely applied, and that regardless of the other things the company does, that you would exclude that company from your selection. Whereas if you're looking at ESG scores, you're concerned about de-risking your portfolio, you would look at the scores, the lower scoring companies. So if scores are from 0 to 100, those companies that are scoring closer to 0 are the higher risk companies from ESG events, and you would either exclude them or tilt away from them, reduce your exposure to them. And those companies that scored better, you would tilt towards or overweight those companies. So that concept of de-risking your portfolio from ESG issues. From a climate perspective, you would assess the companies using a transition risk or a physical risk assessment, as some of the analysis that we saw. And again, where those, for instance, where the physical risk scores are from 0 to 100, where 100 has a much higher risk exposure to physical risks. If you were looking to de-risk your portfolio, you'd be tilting away from those companies that had a higher risk. On the carbon earnings at risk side or the Paris alignment side, again, you would be using the earnings at risk as a measure of of the risk of policy change leading to carbon pricing, and you would be tilting away from those companies and towards companies that had lower earnings at risk in order to de-risk your portfolio and focus on opportunities. The questions are coming in thick and fast, so I'm going to keep answering. I'll just check and make sure that we have. Okay, so we're a little bit over time. There is one question here that I'll finish up and wrap up with. It's what makes the S&P ESG scores better than its competitors? A number of factors come together. I think the unique feature of our scores, the ESG scores, is that we're applying an assessment to companies. That's the corporate sustainability assessment. That assessment's been going on for 20 years. It allows us to ask companies underreported or private information that's not yet publicly available. So we're really able to collect information on issues that are forward-looking in terms of how investors or concerns of investors. And the other thing to keep in mind about the ESG scores and what differentiates them is that S&P has businesses across equities in terms of indices, the largest index provider, and ratings. So we're assessing companies' ability to raise capital through fixed income on their credit score. So with ESG being foundational across all the aspects of companies' potential to raise capital in public markets, the ESG scores have the potential to be the standard ESG assessment. There are many more questions, and I'd love to have more time to answer your questions, but not in this call. If you do have questions, if you ask questions, my contact details are easy to get. So please do send them to me or send them to your S&P representative, and I will answer your questions personally via email or a phone call. So it's been great, and I hope you've enjoyed the session. I look forward to the opportunity to present to you in person.